There is no curriculum for this, no diploma, no transcript, no certification you can put on a resume. And yet, by the time certain 25-year-olds inherit control of a fortune, a business empire, or a seat at tables most people will never see, they already know things that took their parents 40 years to learn. Who to trust, who to call, how to read a room full of people far older and more powerful than themselves, and how to make a decision that will outlive them by a century. They didn't learn this in business school. They learned it the way elites have always transferred real power, through relationships, observation, and apprenticeship, conducted quietly, over years, mostly outside the public eye. This isn't a conspiracy. Nobody is hiding it from you on purpose. It's simply informal, undocumented by its nature, transmitted through proximity rather than paperwork, which makes it nearly invisible to anyone standing outside the family. Today, we're going inside that transfer. The mentorship networks, the summits, the silent advisors, and the psychological shift required to sustain influence across not just one generation, but many. The illusory nature of inheritance. Why the world's wealthiest focus on frameworks, not just funds. When most people imagine the transfer of generational wealth, they imagine a will, a trust fund, a deed to a property changing hands. The story, in the popular imagination, is fundamentally a legal one. Documents signed, assets retitled, lawyers in a room. But spend time around families who have actually sustained influence across 3, 4, or 5 generations, and a different picture emerges. The assets matter, certainly, but the families who succeed talk about something else as the real inheritance, not the capital itself, but the intellectual framework for thinking about capital. How to evaluate a deal, how to read a counterparty, how to know when a relationship is worth decades of patience versus when to walk away. This distinction is not poetic flourish. It shows up directly in how sophisticated families now describe the actual mechanism of failure. Research consistently finds that the overwhelming majority of wealth transfer failures, frequently cited at around 95%, are attributed not to weak legal documents or poor investment choices, but to communication breakdowns, unprepared heirs, and the absence of a shared vision across generations. Put simply, the money rarely disappears because of a bad contract. It disappears because nobody transferred the thinking that built it in the first place. This is why the most sophisticated dynasties now treat the transfer of frameworks, judgment, networks, pattern recognition as at least as important as the transfer of the underlying trust fund or real estate portfolio. A trust fund can be drained by a single bad decade. A well-transferred framework for decision-making tends to compound, generation after generation, regardless of which specific assets it happens to be applied to. Liquid assets versus social capital, what actually survives a recession. Here's a distinction that becomes obvious the moment you look at how dynasties actually behave during periods of market stress. Liquid assets fluctuate with markets. Relationships, by contrast, are remarkably recession-proof. A portfolio of public equities can lose a third of its value in a matter of weeks, as the world saw repeatedly across market dislocations in recent years. Real estate can become illiquid precisely when a family needs liquidity most. Even the most sophisticated direct investments and private holdings, as we've discussed in previous videos on this channel, carry real market risk. What doesn't evaporate in a downturn is who you know. The decades-old relationship with a private banker who will take your call at midnight. The trusted co-investor who will extend a bridge loan on a handshake rather than a term sheet. The political or diplomatic relationship that allows a family to operate smoothly in a jurisdiction that has just become hostile to outside capital. This is what's increasingly described across family office and wealth psychology literature as social capital, and unlike liquid capital, it tends to compound in value precisely during the moments when liquid capital is being destroyed. This is also why the wealthiest, most multi-generationally successful families have always invested disproportionate time, far more relative to dollars than most people would assume, into cultivating and maintaining relationships that have no immediate transactional payoff. The return on a friendship cultivated over 20 years with no apparent business purpose often reveals itself only once, decades later, in a single moment of crisis, when that relationship becomes the only thing standing between a family and catastrophic loss. The public obsession with wills and what it conveniently hides. It's worth pausing on why the public conversation about inherited wealth is so disproportionately focused on the legal mechanics, the will, the estate, the trust structure, when the people actually inside these families consistently describe something else as the more decisive factor. Part of the answer is simply that wills are visible. They become public record in probate court. Estate disputes make headlines. Trust structures can be diagrammed, taxed, litigated, and reported on by journalists with access to court filings. They are, in a media sense, legible, easy to describe in a news article or a documentary. Mentorship, by contrast, leaves almost no public trace. There is no filing that records the 100 dinners over 15 years where a successor absorbed, almost by osmosis, how a parent or mentor evaluated a counterparty's trustworthiness. There is no court document capturing the moment a young heir was quietly brought into a negotiation, told to observe and say nothing, and walked out 3 hours later having learned something about deal-making that no business school case study could have taught. The result is a kind of optical illusion in public discourse. Society fixates on the visible legal scaffolding of inheritance, wills, trusts, estate taxes, while the actual, decisive transfer of capability happens almost entirely in the invisible scaffolding surrounding it. Understanding this distinction is the entire premise of this video, because everything that follows is really an attempt to make that invisible scaffolding visible. The architecture of the apprenticeship. The real shadow curriculum, before 21. What does this informal education actually look like in practice? The honest answer is, it looks far less dramatic than the phrase shadow curriculum might suggest, and far more consistent. According to recent global research into rising generation wealth holders, a substantial majority of the next generation believe conversations about wealth transfer should begin in childhood or adolescence, not at the moment of inheritance, but years or decades before. This isn't theoretical. Heirs frequently describe being brought along to business visits and included, even as children, in their parents' conversations with partners and investors, specifically so that by the time the actual transfer of responsibility occurs, it feels normal rather than overwhelming. In practice, this education tends to follow a graduated structure. Younger family members are first invited simply to observe, sitting quietly in meetings with investment managers, tax professionals, or philanthropic boards, with no expectation of contribution, simply absorbing how decisions are actually made in real time, as opposed to how they're described in textbooks. As trust builds, this evolves into small-scale responsibility. Overseeing a modest philanthropic fund, managing a limited portion of a family investment account under supervision or taking on a defined role inside a family business or foundation. This graduated exposure is deliberate, and it mirrors something family office advisors describe explicitly. Failure at a lower level of responsibility, while the stakes are still manageable, is treated as a feature of the system rather than a flaw. An heir who mismanages a small allocation learns a survivable lesson. The entire architecture of the apprenticeship is designed to surface a successor's actual judgment and capability before the stakes become irreversible, which is precisely the opposite of simply handing a 25-year-old full control of a fortune on a fixed date because a will said so. The content of this education increasingly spans far beyond pure finance. Sophisticated next-generation programs run by major private banks now combine financial literacy with geopolitics, technology, and leadership development. Citi's Next Generation program, for example, runs an annual seminar in partnership with Singularity University, specifically exposing heirs to emerging technological disruption and the risks it poses to existing fortunes, while separate leadership-focused programming has been delivered in partnership with institutions including Cambridge University and MIT. These aren't fringe secretive operations. They are formal programs run by some of the world's largest private banks, simply largely unknown outside the small population of families who qualify to participate. The Silent Advisor, Bridging Generations and Technological Eras. One of the most consequential and least discussed figures in this entire architecture is what might be called the Bridge Advisor, a senior, trusted figure, often but not always external to the family itself, whose specific function is to translate between a patriarch's or matriarch's decades of hard-won experience and a successor's fundamentally different technological and cultural fluency. This role exists because the gap between generations in elite families has, if anything, widened in recent years, rather than narrowed. A founding generation that built its fortune through industrial-era relationships, paper contracts, and decades-long personal trust now sits across the table from a successor generation that came of age inside an entirely different information environment, one defined by instant global connectivity, AI-assisted analysis, and decentralized financial infrastructure that didn't exist when the previous generation made its formative decisions. The Bridge Advisor's job is not to replace either generation's expertise, but to make each legible to the other. This person, sometimes a long-serving family office executive, sometimes an external mentor sourced specifically for this purpose, helps a founder understand which of the successor's instincts about new technology and markets are genuinely valuable insight, as opposed to inexperience, while simultaneously helping the successor understand which of the founder's seemingly outdated instincts about trust, patience, and relationship building are timeless wisdom rather than nostalgia. This is precisely the kind of mentorship that academic and industry research increasingly emphasizes, operates outside formal programs entirely. Mentorship from senior family members or trusted advisors, and notably, mentorship sourced specifically from outside the immediate family, has been found to enable candid conversations that parents and children often find genuinely difficult to have directly with one another. A father may struggle to tell his daughter directly that her business instincts are still unproven. A trusted outside advisor with no emotional stake in the relationship can say the same thing and actually be heard. Why this stays out of public view, it's worth being precise here about why this entire apprenticeship structure remains so far outside public visibility, because the honest answer is less dramatic than concealment and more structural. First, much of it is simply undocumented by nature. A dinner conversation, a quiet aside during a board meeting, years of being brought along to observe, none of this generates a record that a journalist, regulator, or researcher could ever access, not because anyone is hiding it, but because informal mentorship has never been the kind of activity that produces paperwork. Second, families that operate at this level have genuine, legitimate reasons to keep their internal succession planning private, distinct from any notion of evading scrutiny. Publicizing exactly which heir is being groomed for which role, on what timeline, creates real risks, from kidnapping and extortion threats, which family office security teams take extremely seriously, to competitors gaining insight into a family's strategic direction before any transition is finalized, to simple family privacy around what are often difficult, sensitive conversations about capability and readiness among siblings. Third, and perhaps most practically, there is a genuine competitive advantage in maintaining relationships and frameworks that competitors cannot easily observe or replicate. A network built over 60 years, transferred carefully across 2 generations, is a meaningful strategic asset. And like any strategic asset, families have rational reasons not to broadcast its full structure to the outside world. In the same way, a company doesn't publish its complete internal strategy memos to competitors. None of this requires any conspiratorial framing. It's the same reason most families don't live stream their dinner table conversations. Not because something illicit is happening, but because privacy is simply privacy. From transactional networking to lifelong stewardship. Beyond the deal, intergenerational pacts that outlast politics. The networking most people are familiar with, the business card exchange, the LinkedIn connection, the conference handshake, operates on a fundamentally transactional logic. What can this relationship do for me on this specific deal, in this specific quarter? Elite multi-generational circles operate on an entirely different time horizon. The relationships that matter most in these circles are explicitly not built around a single transaction. They're built deliberately to survive political upheaval, market cycles, and the complete turnover of the individuals originally involved. This shows up concretely in how the next generation itself describes its own networking behavior. Recent global research into rising wealth holders found that the majority of next-generation family members turn primarily to their peers, other heirs and successors, for advice, more than to professional wealth managers. These peer relationships, formed in adolescence and early adulthood through shared educational and social experiences, often mature over decades into exactly the kind of intergenerational pact this section describes. A relationship between 2 families, rather than 2 individuals, that outlasts any single business cycle, political administration, or even the lifetime of the people who originally formed it. What makes these relationships genuinely intergenerational, rather than simply long-lasting individual friendships, is the deliberate effort families make to introduce their own successors to the successors of their counterpart families, extending the relationship forward before either founding generation departs the scene. This is precisely the mechanism by which a business or diplomatic relationship formed in the 1980s between 2 patriarchs can still be actively generating value for their grandchildren 40 years later. At each generational transition, the relationship was deliberately handed forward, introduced and vouched for, rather than allowed to lapse with its original participants. The steward, not the owner. A psychological reframe. Perhaps the single most important psychological shift required to sustain influence across multiple generations is one that sounds almost philosophical. A successor must learn to see themselves not as the owner of a fortune, but as its temporary guardian. This distinction has been identified independently across multiple strands of family wealth research as the critical fork in the road between families that sustain wealth and families that lose it. The framing is direct. An owner mentality, where wealth is viewed as something one is entitled to consume, tends to produce exactly the kind of spending behavior that depletes a fortune over a single generation. A steward mentality, where wealth is viewed as something one is responsible for preserving and improving before passing it forward, produces the opposite behavior. Crucially, this disposition cannot be taught through lecture or instruction alone. It develops, according to those who study these families closely, through lived experience. Early work requirements, even within an extraordinarily wealthy family. Privileges that are earned rather than simply granted, and direct exposure to philanthropic work that demonstrates wealth's potential for impact beyond personal consumption. Families that shield their children entirely from consequence, the research consistently finds, tend to produce entitled adults regardless of how much formal financial education those children eventually receive. This reframe, from owner to steward, is also precisely what allows a successor to participate authentically in the kind of 50-year relationship building described above. An owner focused on personal benefit within their own lifetime has little incentive to invest in a relationship whose payoff might not materialize for another generation. A steward who has internalized the idea that they are managing something on behalf of people not yet born has every incentive to make exactly that kind of patient, multi-generational investment. The recurring summit, where influence is quietly transferred. If there's a single visible institution where this kind of intergenerational transfer becomes most concrete, it's the recurring private summit, and these are considerably more documented than most people realize, precisely because the major private banks that organize them are, in fact, willing to discuss their existence publicly, even if the actual content of any given session remains private. Major private wealth institutions now run dedicated annual gatherings explicitly built around this function. One prominent example brings together 2 or 3 generations of each participating family specifically to work through succession planning, wealth transfer, governance, and legacy building, with each family departing the gathering with a customized plan of action informed by the practices of other multi-generationally successful families in attendance. Separate seminar programs, run in partnership with major universities, typically gather several dozen heirs representing 20 or more nationalities at a time, specifically to build the kind of cross-border peer network that will, over the following decades, function as exactly the intergenerational pact structure described above. The specific content of these gatherings tends to follow a consistent pattern: formal sessions on technical subjects, governance frameworks, tax and legal considerations, investment strategy, interspersed deliberately with unstructured social time, dinners, and informal gatherings, because the organizers understand, often explicitly, that the technical content is frequently less valuable than the relationships quietly formed during the unstructured time around it. A seminar on governance theory is forgettable. A 4-day relationship formed with another 23-year-old heir from a different country, a different industry, and a different culture, that relationship may still be generating value in the form of trust, introductions, and shared problem-solving 50 years later. Preserving influence through global upheaval. Adapting to AI and decentralized finance in the mid-2020s. The mentorship structures described so far exist for a single overriding purpose: to ensure a family's accumulated judgment and relationships remain applicable even as the underlying world changes dramatically around them, and few periods test that adaptability more directly than the current one. The mid-2020s have presented dynastic networks with two simultaneous structural shifts. The first is the rapid integration of artificial intelligence into investment analysis, due diligence, and even decision-making itself. A shift we've covered in detail in this channel's Family Office video, where AI-driven research tools now allow small private teams to perform analytical work that once required far larger institutional departments. The second is the continued maturation of decentralized financial infrastructure, which has begun to offer alternative pathways for ownership verification, cross-border capital movement, and asset structuring that don't depend on the traditional banking relationships many older generation principals spent their careers building. Sophisticated multi-generational families have responded to both shifts not by abandoning their existing relationship networks, but by deliberately pairing them with new technical capability, which is precisely the function the bridge advisor role described earlier is designed to serve. The founding generation's deep relationships with regulators, governments, and traditional financial institutions remain valuable. They're simply now supplemented rather than replaced by a successor generation's fluency in the technical tools reshaping how capital actually moves and compounds. Case studies, lineages that survived the 20th century. The instinct to treat the current moment as uniquely disruptive is understandable, but it's worth remembering that the families who have actually sustained multi-generational influence have, in nearly every case, already survived disruption on a far larger scale than anything the 2020s have produced so far. The Rothschild family is the example most frequently cited in family wealth literature, and for good reason. The family sustained and grew dynastic wealth and influence across more than 2 centuries, a period that included revolutions, the complete redrawing of European borders, 2 world wars, and the collapse of multiple currencies and political systems the family had previously relied upon. The mechanism credited with that survival was not any single brilliant investment, but a deliberately distributed family structure, branches established in different countries, maintaining independent operations while still coordinating through trusted family relationships, ensuring that political or economic catastrophe in any single nation could never threaten the entire family's position simultaneously. A broader pattern shows up across multiple European industrial families that have passed operating businesses through 5 or 6 generations of consistently competent leadership. Families far less famous than the Rothschilds, but studied closely within family business research precisely because their survival contradicts the otherwise dominant shirt sleeves to shirt sleeves pattern discussed in this channel's earlier video on family offices. What these lineages share is not luck, but a consistent, deliberate investment in exactly the apprenticeship and stewardship mentality structures described throughout this video, treating heir preparation as seriously as any other strategic priority across every single generational transition, rather than assuming competence would simply emerge on its own. The lesson dynastic families explicitly draw from this history and apply directly to current disruption from AI and decentralized finance, is straightforward. The specific threat changes every generation: currency collapse, war, revolution, today AI and decentralized infrastructure, but the underlying survival mechanism does not. Distributed structure, patient capital, and deliberately transferred judgment have proven durable across every major disruption of the past 2 centuries, which is precisely why today's most sophisticated families are applying that same mechanism to the current one, rather than treating it as an unprecedented problem requiring an entirely new playbook. Geographic diversification and the citizenship hedge. The same distributed logic that allowed historical dynasties to survive localized catastrophe has, in the current environment, taken on a very contemporary form. Geographic diversification of both assets and the family members themselves. As discussed in this channel's previous video on family offices, the operational infrastructure of dynastic wealth has increasingly moved toward jurisdictions such as Singapore and the UAE, which now host a substantial concentration of global family office activity. But the diversification described in this video extends one level further, to the family members themselves, who increasingly maintain residency or citizenship options across multiple countries, specifically as a hedge against localized political or economic instability affecting any single jurisdiction where the family has historically been based. This isn't simply about minimizing tax exposure, though that remains a genuine consideration. It's about ensuring that no single government's policy shift, currency crisis, or political upheaval can threaten a family's entire position at once. Precisely the same logic the Rothschilds applied across European borders 2 centuries ago, updated for a world where mobility, banking access, and legal protection now depend as much on a passport's specific privileges as on physical geography itself. The future of distributed dynastic power. Digital legacy and the oversight of autonomous systems. The mentorship structures discussed throughout this video are, themselves, now evolving to address an entirely new category of inheritance. Not just physical and financial assets, but digital infrastructure and increasingly autonomous, AI-driven systems that generate or manage wealth with limited ongoing human input. This represents a genuinely new dimension of stewardship education. A successor today must learn not only how to evaluate a deal or navigate a relationship, but how to oversee automated investment and risk management systems that may be making thousands of granular decisions per day. Understanding their underlying logic well enough to recognize when those systems are functioning correctly versus when they require human intervention. This is a fundamentally different skill from the relationship-based judgment that defined previous generations' education, and sophisticated families are only now beginning to build deliberate mentorship structures specifically addressing it, typically by pairing technically fluent younger family members with the same kind of bridge advisors described earlier, ensuring that oversight of autonomous systems remains grounded in the family's broader values and risk tolerance, rather than becoming a purely technical function disconnected from the family's actual judgment. New power blocks, built on old world structures. It's worth noting, in closing, that the architecture described throughout this video is not exclusive to families whose wealth stretches back centuries. A distinct pattern has emerged among newer fortunes, particularly those built within the past 2 or 3 decades through technology, finance, and other rapidly compounding industries, of deliberately importing exactly these old-world structures: family constitutions, formalized next-generation education, recurring summits, and explicit stewardship mentality cultivation, often built consciously in direct imitation of the multi-generational families this video has discussed. This represents something genuinely new. Newly wealthy families looking at the multi-century survival of lineages like the Rothschilds and reverse engineering the mechanism rather than assuming their own fortune will simply persist on the strength of the underlying business alone. Whether these newer power blocks succeed in sustaining influence across multiple generations, the way their historical predecessors have, will depend on precisely the same factors discussed throughout this video. Not the size of the initial fortune, but the seriousness with which each family treats the deliberate, patient, multi-generational work of transferring judgment, relationships, and a stewardship mentality forward to people who, in many cases, have not yet been born. Final takeaways: decoding the true trajectory of global leadership. Here is the central idea this entire video has been building toward. If you want to understand where global influence is actually heading over the next several decades, the public, visible markers, quarterly earnings, election cycles, headline-grabbing deals, tell you only part of the story. The deeper, more durable signal is the one almost nobody examines because it leaves almost no public trace. Which families, which networks, and which lineages are investing seriously right now in the patient transfer of judgment, relationships, and stewardship mentality to a generation that, in many cases, is still in school. The families and networks making that investment most deliberately today are not necessarily the wealthiest or most visible right now. But based on everything 2 centuries of dynastic survival has demonstrated, through revolutions, wars, currency collapse, and now AI and decentralized finance, they are very likely the ones whose influence will still be compounding, quietly, 3 generations from now, long after most of today's headlines have been forgotten. That's the actual scaffolding behind multi-generational power. It was never hidden out of malice or conspiracy. It was simply too quiet, too informal, and too embedded in ordinary family life for most people to ever think to look for it. Now you know where to look. If this gave you a new way to think about how influence actually moves across generations, subscribe. We go deep on the real architecture of dynastic power and wealth every week, well beyond what most channels in this space ever cover. Let me know in the comments, which part of this structure surprised you most? The bridge advisor role, the steward versus owner psychology, or the historical Rothschild parallel? I'll see you in the next one.